Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. As the Labour Party celebrated its first full week in government, there was some cheering news in the economic data, with the UK returning to positive, if anemic, growth, according to the latest GDP figures, and evidence of inflation falling, particularly in the United States, which has prompted the markets to return to expectations that the first interest rate cut across the Atlantic will come in September. Although the chairman, Jay Powell, insisted that the Federal Reserve still wants to see clearer evidence of a sustained fall in the rate of inflation before it takes that step. The stable government with a large majority that we have elected in this country is in stark contrast to the turbulent politics now playing out in France and elsewhere across Europe, which may well have something to do with the fact that the pound has continued to strengthen against the euro and is nudging towards 130 against the dollar. In the US, of course, questions about Joe Biden's fitness to serve another term continue unabated in the media, at least. On the podcast this week, I shall be talking to Andrew Jones, the highly regarded CEO of LondonMetric, the listed property company which in the last year has completed the opportunistic acquisitions of not one but two listed UK commercial property investment trusts in the shape of CTPT and the much larger LXi REIT, a deal that completed in March. What is the rationale behind these two deals, which will create a company with £6 billion of assets, making it the third largest REIT in the UK? And what does it tell us about the state of the commercial property investment trust sector that LondonMetric can pick up these two trusts so easily, using its more highly rated shares? I think you'll find this an interesting and thought-provoking discussion. It was a quiet week for news in the investment trust sector, meanwhile, but not perhaps an insignificant one in terms of price movements, with the average discount coming in to around 13%, its lowest level for some time. Gilts rose pretty much across the board this week. That's consistent with lower interest rate expectations, of course. And there was a sharp fall in the share prices of some of the big mega-cap tech stocks on Thursday, following the latest inflation figures, because that heightened speculation that the domination of the mega-cap big tech stocks may finally be coming to an end, leading to rotation towards other styles and sectors that have been dwarfed while the mega-cap stocks have been powering ahead. So, for example, biotech specialist trusts, including international biotechnology and biotech growth, were among the biggest gainers this week in share price terms in the investment trust sector, along with UK small-cap specialists such as Aberforth, Aberdeen UK Smaller Companies and BlackRock Throgmorton, while some of the infrastructure trusts, such as INPP and BBGI, which are often regarded as bond proxies, were also notable gainers on hopes that interest rate cuts may indeed be on the way. Among the losers, Vietnamese and Indian specialist trusts featured quite prominently. Overall, however, gainers outnumbered losers by around 4-1, and the investment trust index finished up a little over 1.5%, which is ahead of both the FTSE All-Share and the S&P 500. Both of those two up around 0.8%. Nasdaq trailed in behind them. While copper and oil both declined marginally on the week, gold was up, breaching the $2,400 mark again, which it has breached once before this year. It was a sparse week for results in the investment trust sector, however, with just 3 trusts reporting full-year figures for the period to the end of March, albeit with very different outcomes. While 24 Income, the fixed income specialist, reported NAV total return of an impressive 18%, there was a disappointing decline of 12% NAV total return at Miton UK Microcap, which is well behind its benchmark. Elsewhere in the news, Chrysalis, the early growth capital trust, reported an NAV gain following confirmation that the UK microchip making company Graphcore, once held up as a potential rival to Nvidia, has been sold to SoftBank of Japan, albeit at a price that is 75% lower than its peak valuation just 2 years ago. So while there's a NAV gain, this particular investment has not made any money for Chrysalis, which already marked down its value more recently. Other trusts that have a stake in Graphcore include Schiehallion, Edinburgh Worldwide and Schroeder British Opportunities. Also in the news, Addition Investment Trust, the UK small cap specialist, which is one of the few trusts to be still trading at a premium, announces doing a small placing, will close next week, to raise a few £1 million, this one being open to retail investors. For subscribers to the Moneymakers Circle, our trust profile this week features Target Healthcare, the care home provider, and they'll also find their portfolio performance reports from two of our regular contributors, reporting how well they've done in the first half of this year. It's been a decent one, it's fair to say. And a column by Edward Chancellor, the financial historian, about stock market bubbles. Plus all our usual other features, including the biggest share price, NAV and discount movements this week and year to date. Finally, if you will indulge me in a piece of shameless self-promotion, and if you are one of those lucky people who've been sent a nomination form for the AIC's annual Investment Trust Media Awards, I wonder if you'd be willing to put forward the podcast as a nominee in the broadcast category, or indeed any other of the content that we produce, Investment Trusts Handbook and the Moneymakers Circle newsletter. We've been going for 4.5 years with the podcast, and I guess my view is that it's a good time perhaps to seek some recognition for the sterling efforts that my colleagues Ben and Stuart have put into keeping you all, I hope, up to date and entertained about the goings-on in the investment trust world. I had a good opportunity this week to speak to Andrew Jones, who is the CEO of LondonMetric, a well-known REIT that is actually not classified as an investment trust, but has been very active in the investment trust sector by means of acquiring, through merger, 2 investment trusts in the last couple of years. The first of that was a CT Property Trust, and the second, much bigger deal, was the merger with LXi REIT, which only closed, I think, in March this year. So that has created a very large real estate investment trust business. It's got assets of around 6 billion, and I think is the third largest in the UK. So it's been a very active period for you, Andrew, and you have taken advantage, shall we say, of the way that the investment trust sector has evolved over the last couple of years in the face of rising interest rates. You moved in quickly to make these 2 acquisitions. Tell us how they came about, whether it was something you were looking for or whether you were approached by others and so on. How did it all come about that you managed to make these 2 deals in a relatively short period of time?
Yes, Jonathan, let's start with CTPT. I mean, it was a company that had a portfolio that we coveted for a number of months throughout the middle of 2022. We couldn't quite get our heads around where the price had got to and decided to take stock. Came back just after the summer and the market had recalibrated following the trust budget in the autumn of 22. And certainly the impact across the market was pretty severe. But actually, it was some of the smaller caps, less liquid names that suffered the most. And you saw their share prices being hit pretty hard. So at the start of 23, we took a fresh look at it. They'd changed their chairperson. And we made an approach early part of 23 and managed to agree a structure that worked for both sets of shareholders. And I would say the execution and also the integration of that portfolio has gone very, very well. I think it's been a good transaction for both sets of shareholders.
What were the attractions of that particular trust to you in terms of assets?
Well, it had a high concentration of logistics warehouses, which is our strongest conviction call across the commercial real estate sector. It also had some out-of-town retail assets, which we were also comfortable with. And the pricing allowed us to accurately allocate figures to the non-core office and high street assets that gave us confidence that we will be able to monetize those in the direct market shortly after closing the transaction. So we liked the portfolio. We were able to get to the pricing that I felt comfortable with. It also came with a very attractive debt book with fixed rate debt at a low coupon and well below where the market would have been back then or even today, to be frank. And it also had just over £30 million worth of cash on the balance sheet. And we were able to structure it as an all-share transaction as well, which also meant that we lowered our gearing and our LTV. So there were a lot of things going right for it. And we have set about then selling out the non-core assets at the prices that we'd allocated to them.
So that was the first bite of the cherry. And then you turned your sight to LXi REIT. I'm sure you know the principals of that company very, very well for over many years. How did that one come about? That was a meeting of minds, was it? Or was it opportunistic as well?
Yeah, I think it was opportunistic. We reacted to a request to look at the business by their board and actually came in the summer of last year. We weren't able to pursue because we were still trying to close the CTPT transaction. So again, came back after the summer, after CTPT had closed at the beginning of August, and delved deeply into the LXi portfolio. And these transactions all have to start with the assets. You've got to like the majority of the assets, and then you've got to be comfortable that the assets you don't like, you will be able to successfully monetize in the direct market. And so therefore, as we delved deeper into that, we liked more of the assets. We got very comfortable with the structure. And also we believed that it was going to be incredibly earnings accretive to our shareholders. And it was going to deliver us some material uplift in both our earnings and obviously our progressive dividend. So it was still opportunistic, but as you pointed out earlier, it's a much larger transaction and it only closed at the beginning of March. So it was obviously still early days and we're working through the integration and the sale of non-core.
I guess the question really is about these two deals that you've done. The fact that the investment trust sector, the commercial property trust, along with many others, had derated, was that a factor in creating the opportunity for you? You wouldn't have been able to do that without that.
Yeah, absolutely. So, without a doubt, CTPT in particular had derated materially. I think the summer before we re-engaged, I think those shares were close to £1. And when we came back in January to look at them, they were closer to 50p or maybe 60p. So they derated materially. So without a doubt, the derating created opportunity there. LXi was similar, maybe less stark. Obviously, the attraction that we had is that the LondonMetric rating didn't derate as materially as the other two companies.
Right. So you're able to use your superior rating of your shares to complete these deals. Yeah. So what does that tell us, though, about the listed investment trust sector and commercial property? Before we go and talk about what you're doing, but what does that tell us about that particular sector, that it created these opportunities for you?
I think size and liquidity are very much coming to the fore. I mean, we never set out to create a very large real estate investment trust. We set out to run one that was considered to be one of the smartest in the sector, but never necessarily the largest. But I think that over the last decade or so, size has become more important. It does give you economies of scale, particularly in the debt markets, also increasingly in the equity markets, and also with some of your customers, occupational customers as well. And so people need liquidity. Investors want liquidity. And so they focus on maybe some more liquid names. And those are smaller, fall by the wayside, and shares trade by appointment only.
Right. Well, LXi REIT was not particularly small, though, was it? I mean, it was a couple of billion in assets and so on. But I'm just wondering whether you think there is an issue around the investment trust commercial property sector. You've made some comments, for example, that you think that self-managed companies on the whole are better than externally managed property companies. There's been this issue around cost disclosure, obviously, which may be a factor for some investors in these things. But justify that view to me, why self-managed is better than externally managed.
Yeah, I mean, I've been very critical of external managed structures for a number of years. And I think, again, part of the opportunity in LXi was the fact that it offered an internally managed solution to the board and to their shareholders. My issue with externally managed is completely the lack of alignment in nearly all of the cases. Not all, but nearly all. I mean, there are some externally managed REITs out there that do have strong alignment of interests. But it was the lack of alignment, I think, brings in a lack of discipline when it comes to capital allocations, when it comes to equity raising, when it comes to looking at the quality of the opportunities as they present themselves. And I think that it is a case of investors need to be incredibly wary of external structures. Whilst I'm not suggesting all internals are managed fantastically, remuneration is much more closely aligned to shareholders.
Right. And there is perhaps a bias towards asset accumulation rather than optimizing the use of capital?
Yeah. And look, spending is much easier than investing. If I raise £100 million today, I think I could probably spend it by close of play Monday. Finding smart investments for that 100 million would take me a lot longer.
Okay, so you've completed these deals, and well, we've seen quite a lot of activity in the commercial property sector, particularly the investment trust listed sector. So what have you got to do to justify making this deal work and actually produce extra returns over and above what you would have made by not doing the deals?
Like I said, the scale gives you economies. I mean, certainly on the cost side, both transactions added significant number of rental income to our top line. They're both incredibly earnings accretive, and that flows through to our dividend policy. I think that we need to prune the portfolio a bit to get rid of some of what I consider to be the less desirable assets, which we're underway with. And like I said, we've made great progress on the integration of the CTPT and the sell down of the non-core, which I'm pleased with. And I think we want to run our winners harder. It's sell the losers and run the winners. And that is a greater intensity to ensuring that we own great assets, we have occupier contentment. And I think that those two ingredients are quite important for making sure that we deliver income growth over the medium term, which continues to drive our EPS progression.
So perhaps it may be worth restating, for benefit of our listeners, exactly what the objective of your company is. You say it's to generate income and then to compound that income and let it grow over a period of time. So do you have a kind of target rate of return? Is that a realistic concept to ask you?
Well, the problem if you have target growth rates is that it sometimes dissuades you from selling your poorer assets. I like to deal from the bottom. We value income and the compounding qualities that come from that and income growth. And our objective is to deliver the best long-term risk and stress-adjusted returns across the real estate sector. We are the UK's largest, what we call triple net REIT, which means that we are able to run our £6 billion portfolio with a very tight team. And that helps our EPRA cost ratio. We will have the lowest EPRA cost ratio in the sector. We have a small group. We have 45 people, all like-minded. We have 2 offices, a main office in London, one in Birmingham. And that allows us to run our portfolio, we think, as efficiently as anybody else. We tend not to do direct development in any material way. We leave that to the others because it interrupts our income compounding.
Just to repeat for those who don't know, but triple net means that your leases with your lessees, they are responsible for the operating costs, for the insurance, maintenance, taxes and so on. And you just provide the property essentially and take the net rent.
Absolutely.
So it's simpler and saves you a lot of headcount and so on.
Absolutely. We have a red line, and everything within the red line is the responsibility of the tenant whilst they remain in our buildings. Whether or not, as you say, it's the repairs, insurance, the energy. We just collect full rents a year, and every year or every 5 years, we hope to increase it.
Right. Simple can be good. Let me ask you then, in terms of, there's 2 things going on here. We obviously had the issues in the investment trust sector, the listed investment trust sector, but there's also a property cycle going on at the same time, which is not unrelated, I think. But tell us where you think we are in the property sector, if you'd be so good, and what will be the sort of trigger to improve things if they have been deteriorating, or to make them worse if they aren't.
We've had a recalibration of asset values, obviously, since the autumn of 22 with the uptick in interest rates. And that has obviously had a knock-on effect on real estate and most other investments too. Those rate increases, obviously, we hope have come to an end. And in fact, we hope they're going to be reversed shortly. I think, though, across the real estate piece, what you are seeing is a polarization between winning sectors and losing sectors. There are a number of commentators that refer to the winning sectors as beds and sheds. And some of the more established uses, offices, shopping malls, look a little bit more exposed. And a lot of that, I think, that divergence and that polarization of performances, a lot of it is being driven by evolving consumer behavior, largely driven by technology. Obviously in retail, the internet has had a dramatic impact on consumers' desire for physical shopping. And not that I think that all physical shopping disappears. Again, we just have to reprice it. And similarly, in offices, we've seen work from home, but we've also seen an acceleration of preferences for better workspace, more amenities, better energy efficiencies, which has quickened the time frame for which an office building might remain fit for purpose. When I started in this industry, it was pretty common that the office lease would be a 25-year lease with 5-yearly upward-only rent reviews. Today, I think that lease is probably no more than 15, or in certain circumstances, maybe even 10, with break clauses and flexibility built in. And that makes the whole office equation more difficult to stack up. I think, though, as a sector as a whole, I think the big catalyst that we're all looking for is a movement down in the 5-year swap rate.
Yeah, so you need lower interest rates, effectively, or lower funding costs. Yeah. Also, we've seen a lot of cases of property companies that have gone into trouble because their balance sheets are stretched. That was a big issue after the global financial crisis, but it's different this time. People are more prudent than they were, perhaps.
Yeah, I think the UK listed real estate sector, as far as the balance sheets are considered, largely in a great place compared to where it was as we came out of the GFC. In fact, I would argue that the UK REIT market is in better shape than any of the continental markets as well. So I don't think that we have that issue, certainly amongst the publicly traded vehicles. There may be greater leverage issues in the private sector, and there will be more stress, I suspect, on office and certain retail portfolios than there will be in warehousing and housing portfolios. And I think you've seen some examples of that more recently with some of the smaller regional companies, particularly, like I said, in the office sector.
Yeah, well, we saw that heavily discounted rights issue from Regional REIT will be a classic example, I suppose. So your game is about finding the best sectors and being brave enough to go after them before everybody else. So essentially, that's your sort of pitch to investors. And at the moment, you're in the right place. As you say, you're into sheds, at least. That's been your biggest bet, I think. And you're not too exposed to retail, supermarkets or offices, basically, which are the place not to be. Is that right?
No, I think convenience retail, it looks interesting. Aldi, Lidl is a big customer of ours. Marks and Spencer's Food is a big customer of ours. So we're very happy with that bit. We also like entertainment. The LXi merger brought with it 4 big theme parks, Alton Towers amongst them. And that's a sector that we think that, again, lends itself to consumer behavior for greater, I suppose, fulfillment and interaction and experience. So we're very, very comfortable with our investments with Merlin. And we've also acquired a portfolio of private hospitals, which again sits comfortably with a thematic that an aging population will spend more on its healthcare going forward. So we've got some really, really good positions in winning sectors. And obviously the immediate focus is to come out of sectors where our convictions are a little bit less, or the portfolio is not of a scale, or exposure to that portfolio is not of a scale where we think we can make a difference.
Right. So if you take logistics, for example, that's had a very positive trend, a tailwind behind it for quite some time now. Everybody wants to get into it. So you can still acquire things at prices that allow you to make decent returns, or sufficient returns anyway.
Yeah, look, I think we are seeing pockets of opportunity in the direct market today, coming from fund redemptions. You're seeing a number of defined benefit pension schemes looking to come out of direct real estate. You're seeing some companies looking to explore the sale and leaseback market to raise money against property, maybe more cheaply than they can against their banking facilities. There are further M&A candidates out there, and I suspect that we will see greater consolidation over the next year or so. And so we're attuned to all of those pockets of opportunity. I also think that the returns that we're seeking are enhanced by the income growth that we expect them to deliver. So it's not just the price we pay today, it's the reversionary rent that we think we can collect from them over the coming periods.
And there's some other sectors you mentioned in your recent presentation and results, which I thought was interesting, but ones that you're not interested in. Perhaps you could explain why. So you mentioned student housing, build to rent, and data centers as being examples of sectors that don't fit your model. Do you have a view, though, about whether they're attractive sectors or not?
I mean, data centers actually we're very happy with. It's a scarcity issue more than anything. We actually have 6 data centers, which we're very comfortable with. It's just not the easiest sector in which to grow at the moment. And that comes down to power availability. As for beds, student and BTR or PRS, as we refer to it in the sector, are both good sectors, but they are much more operational. They don't fit the triple net thematic that we seek. I mean, I actually sat on the board as a non-exec of Unite Student PLC for a number of years, and it is a wonderful company. It's a strong sector, but it is very, very operational.
Right, so it just doesn't fit your particular model, as you say. Another thing you've said often is that the macro will always trump the micro. That's a good phrase. And you've also said that you're still waiting for the all-clear signs to appear for the sector. So coming back to that issue, what are you most concerned about as far as the macro is concerned? What could go wrong?
I've thought for a while that the UK consumer is actually in pretty good shape. A large proportion of us are facing higher interest rate costs, on mortgages and credit card bills and what have you. But also you also have to appreciate there's a large proportion of the population that are savers and they will have benefited from that. But my optimism about the UK economy is driven by the jobs. The employment data is extremely strong and that can trump all. And so there is uncertainty in the markets, but I think that from a consumer perspective, I think we're in great shape. I think my reference to all clear is that we're not waiting for the all clear sign to appear, because if we wait for all clear sign to appear, then the competition in the direct market becomes more intense. If I wait for the 5-year swap or the 10-year gilt to drop from 4% to 3%, then I'm going to have a lot more competition when we come to seek out some of these opportunities from pension funds and fund redemptions and sale and leasebacks. So we're not necessarily waiting for that. So we're cautiously progressing. We're continuing to make good acquisitions. We're continuing to prune the portfolio of the non-core assets. And I feel that is an opportunity for us. When liquidity returns, as inevitably it will, we will find it easier to sell assets, but harder to buy.
Yeah, hence the advantage of moving earlier than others if you can. So where does that aspect of your management style come from? That's a sort of more entrepreneurial approach than some you would think. To some people, it would think it carries more risk, but you're confident in what your judgments are. So where does that come from? Why are you doing things that others can't do?
Well, look, we think we've backed the winning sectors. We think we've developed what we refer to internally as an all-weather portfolio. We've now entered our 10th year of dividend progression, and our dividend is well covered, which again puts us in a more elevated position than many of our peers. And backing the right sectors goes back to what you referenced earlier. The macro is more important than the micro. The tailwind from being in logistics has been incredible. All we're trying to do is to add to that a little bit if we can speed up the performance. But by and large, even if we did nothing on our logistics portfolio, we would have done really, really well because we got on that train relatively early. I think our sector is, there's a lot of management teams that are wedded to historical attachments. They've been in shopping malls, so they stay in shopping malls. They've been in offices, so they stay in offices. They've been in development, so they stay in development. I mean, there hasn't been a huge amount of pivoting going on. We've been a little bit more fleet of foot, and the market's been kind enough to support some of those pivots as and when we've made them. The truth is, we have an incredible ownership culture in our business. And as I said, very much a like-minded group of people. And that means that we have to explain what we're doing. And we've been able to do that. And the stock market, as I said, has been incredibly supportive, which is why we enjoy a relatively higher rating than a number of our competitors.
Yeah. I guess what I would have to say is that obviously it's been a very difficult period for the commercial property sector. I looked at your share price and so on, and I think over 5 years, the total return is still only around 2% or something like that. So the share price is back to where it was sort of 5 years ago. But over 10 years, you've done much better, 7% in a low interest rate environment. That's very good. And obviously a lot of your competitors have done much less well than that. So is it a case where if things go well, you will be able to get back up to some kind of strong positive real return? And commercial property is a real asset, so you would expect it to deliver something in excess of what gilts are yielding anyway, producing it.
Yeah, look, I think one of my peers coined the phrase that, at the moment feels like we're running a 5-year swap business, not a great real estate company. So any views that come out of the Fed or the Bank of England that suggest that rates are going to fall more or quicker than maybe the market's priced in has an incredibly disproportionate impact on our share price that has nothing to do with me and what the team are doing. And that comes back to my comment around the macro. What we want to do is make sure that we have great assets in the winning sectors, because as the macro markets, the clouds clear and the rates start to come down, we think that we will be in the best position to benefit.
And in terms of your shareholder register, do you have ambitions to change that in any way? Are you interested in attracting more pension fund money or more direct investors, private investors? What's your sort of feeling about that?
We have an interesting share register that is a combination of big institutions, global money, but also a high proportion of private client wealth managers, courtesy of the high dividend yield that we have and the trajectory that we've delivered over the last decade or so. And quite frankly, they are important to us. I don't have a particular preference of one type of investor over another. I think my job is to try and broaden the fan club and widen it as much as I can. And if that involves going to parts of the world to see if we can find some supporters, then that's what I will do. But we're happy with any shareholder, quite frankly.
You're now $6 billion in assets, as you've said. Are there some kind of limits on how big this company could become?
For me, size should be the outcome of a successful investment strategy. It's not a target. We don't have a target, never had a target. I do like running a tight team of people. I do like the fact that we are a very, very close team. I like the fact that I think that the sum of the whole is greater than all of the individual parts. And, many of us have worked together for decades. Do I have ambitions for our team to double or treble? No, absolutely not. But I've no doubt that because of our triple net investing thesis, I think that we can still do more than we're doing without diluting the value add that I get with a best-in-class team.
And if I can ask you then also just about government, we've had a general election. Obviously, we've got a new Labour government. What is it that the government, any government, but this one in particular, could do that would help your business in any particular way? What would be the number one thing you would like to see?
Yeah, I don't focus on what they can do for my business. I think what they could do for the sector, I'd probably categorize it as probably three things. One would be investment in infrastructure. That would be positive. I think that in certain areas of the country, we could do with greater planning resourcing. Not everywhere. I think there's some planning authorities that deliver a terrific service, but there are other areas where resourcing is tight. Thirdly is probably an overhaul of the rating system. I actually don't think it requires massive recalibration or restructuring. But again, you have to reflect the fact that you can't have high street rates running at higher than the rents that are being demanded. That's not quite what the intention was. So I think infrastructure planning and a rating overhaul would be my top three. But I do think that what we do have now in the UK is a stable government, which is a rare commodity when you look across to some of our trading partners in both Europe and across the pond.
Right. Would you ever consider doing things overseas, outside the UK?
I know we have a circle of competence in the United Kingdom and we'll stick to it. I mean, I'm not sure I need to go into Europe to start proving that we know what we're doing. No, absolutely not. Europe's for holidays.
Very good. Right. Thank you. Was there anything I didn't cover here that you wanted to talk about?
I mean, I think the one thing that is in our sector, and I think Marcus Fairmudge touches on it a bit as well in the interview he did with you, is you've got some of these big REITs that have just clung to the old ways of what they did back in the 80s or the 90s or even the noughties. And they just, we've had technology, we've had incredible innovation. The fact you and I are talking like this, I'm not sure we could have done this 5 years ago. I'm not even sure this facility existed. And that has to impact our thoughts on, do we like offices as much as an investment? I'm not saying you can't make money by buying a rubbish office and spending money on it and selling it for more money and all that. But I'm just talking as a long-term, stable investing strategy. I think offices are more tricky. I started my career in shopping malls. I'm too frightened to go back there. I just don't know what's going on. It's too difficult to work out. I suppose that's my only comment about our sector, is people seem to marry their sector and are not prepared to ever look outside it. But like I said, their lethargy is maybe our opportunity.
Yeah. But are there any sort of sectors in particular you've got your eye on, which perhaps you wouldn't want to tell me anyway, but you might?
No. No, I mean, in a small way, just going back to that, I didn't say it because I didn't want everybody else to think about it. But, convenience retail, and if you think about how we shop these days for our groceries, we are much more focused on. I remember when growing up, my mother used to pick me up from school on a Wednesday and drive me to the big Tesco's, and that would be the weekly shop, the big shop, as we used to call it. Now, if you think you could drag your children to do a weekly shop like that, then you'll have been a better parent than me. And now it's about, let's pop in on the way, pick it up from Tesco Express, pop into Lidl 2 or 3 times a week, or a resurgent Marks and Spencer's. And the adjacency to that for us has been, we've got, like, for example, drive-through restaurants. The growth of food delivery and takeaway come from a McDonald's or a Burger King or a Costa or a Starbucks. We own 75 drive-through restaurants. And that's consumer behavior again. They would rather go and get a drive-through than sit in the restaurant.
Yeah, it's strange, isn't it? I mean, there are lots of them, many of them sort of side by side, yeah.
So on the A34 between Oxford and Bicester, just before you get to Bicester, in the Starbucks, and then they went and built a KFC in the car park. And that's great. And then you get to Bicester, and then you'll find that just before you turn into the outlet village, there's a new Starbucks and a new Burger King that's just popped up that we own. Whereas we could go into, even Oxford, without being rude. I was looking at a picture of the Debenhams in Oxford the other day, and they don't really know what to do with it. So I think they're trying to turn it into a life science facility or something, which is what people tend to do, is when they can't think of anything really sensible to do with it, they call it a life science opportunity, hoping that that's going to get them out of jail.
Yeah, the centre of Oxford is very interesting. There's a new shopping centre, but there's also a lot of empty shops around the place, and most of those that are open are Costa Coffee or something.
I know, and that's the point. I was brought up in Wales. The days when I used to catch the 32 bus to go into town for an afternoon of just walking around, chatting with my mates and bumping into school friends, we don't need that level of comparison goods shopping anymore. My wife will order her dresses or the shirts or my shorts for the summer online, and the ones we don't like will get sent back.
Hence, it's good to own the warehouses and the distribution centres.
So the warehouses have been a great play. It's been an incredible journey, probably worked out even better than we might have hoped, to be honest with you. But our recent conviction is more towards what I call urban warehouses, that can do that same-day delivery. Because if you think about even around Oxford, actually, a lot of the land is being repurposed for higher value uses. I remember going to see Neil Woodford in his office by the Cowley Works. Would you build those? I'm not sure you'd build those again. I think it's been rebadged now probably as the Oxford Science Park, or you know what I mean? It is actually a business park that was developed by Arlington Securities back in the noughties. But let's call it something else, and then we hope we can put a different yield on it. So I just think this evolution of consumer behavior is defining certain sectors as being more popular than others. You don't have to make money back the same way you lost it, which I think is a Warren Buffett quote, actually.
Yeah. But eventually, of course, you can have too much of a good thing, can't you? And then you get oversupply, and then you get overcapacity, and so on. And then you're back into a new cycle when you've got to find the next best thing.
Absolutely. What is that Warren quote? A pin waits for every bubble. And when the two eventually meet, a whole group of new investors learn some very old lessons.
Indeed.
Warren is my superhero.
Yeah, I've been lucky. I met him once, and twice, actually. I went to Omaha.
I went as well.
Did you? Fantastic, yeah. And it's all presented in this very homely way. It all makes sense, and the lessons take a lot of learning.
I was listening to a podcast that a friend sent me, and it was an interview with Terry Smith, which I also found quite enlightening. He speaks very sensibly.
He's very good. Yeah, I absolutely agree.
I like him. And our real estate approach is not a million miles away from those. It is buy well. And if you buy the best assets, what do we say? We say, when you buy quality, time creates wealth. When you buy secondary, time can destroy it.
Yeah, very good. These old sayings, they all have merit. So that was Andrew Jones, who's the CEO of LondonMetric, which has been hoovering up some assets in the UK-listed investment trust space and doing so far with considerable success.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.